Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So the best thing about straddles is you don't really have that gap risk. In fact, it actually helps you if there is some gap, correct?
Absolutely. One of many benefits is that you are long, that the gap is your friend now all of a sudden. I mean, in many cases anyway, the gap is your friend. Clearly, when we talk about long gamma, the more the market goes up, the longer you become. The more the market goes down, the shorter you become. So the market has rallied significantly from your straddle. One thing that you want to maybe adjust your position size is if the market heads up to 151, 152 on the euro and the spot euro FX and the spot euro USD, maybe that's a spot you want to get short a little bit or take some profits from the long side and readjust your overall straddle exposure. And so a gap down would obviously back in your favor would help out. A gap up wouldn't necessarily hurt you because if all you did was go to delta neutral, then again with the rising market, your gamma begins to increase again. So there's a lot of variables and ways this can play out. But the bottom line is that you have defined your risk for the month, and now and if you're a person that likes to play big moves, it's a great way to get involved in a market to do that.
What's the disadvantage? The reason I bring this out, John, is I get this question is, why wouldn't everyone always trade straddles?
Because the market's not always in a long gamma situation. The market gets in a short gamma situation as well. And when we see rich premiums like we do right now, we're going to talk a little bit later in the presentation about calendar spreads. And I think that there's some situations setting up. In one particular exchange right now, the options on the euro expire in 4 days. They expire on Friday, actually. I think there may be some opportunities there. But to answer your question directly is that we're not always in a robust trading market like we've seen in the last 3 months. We are in markets that maybe get a little more range bound or premiums are too richly priced, and they offer us an opportunity to maybe sell the front month and maybe to buy the back month as a hedge. Or you can put on a butterfly spread, which I don't get into tonight. That's for down the road. But the great thing about whether you're long gamma or short gamma, I would never try and pinhole a person to one particular strategy. But clearly selling straddles, or even maybe I would never recommend someone to come in and just sell naked straddles as they're getting into this game. But maybe working a butterfly or bear call spreads and bull put spreads is a way to sort of get their toe in the water for starters. And again, I know I'm flying off with a lot of stuff here. So please, hit the questions up in the chat, and I'll make sure that everyone is addressed before I get off and end this presentation. All right, and we talked about the straddle there. Now going back to the moving on to the short straddle situation. You see, unlike the long straddle where our max loss sits at minus $8,000, okay, on the short straddle, our max gain is at plus 8,000. And so our whole time when you're short a straddle is really spent babysitting. And I can say as a guy that's been short straddles and been short in long straddles, when you're short the straddle, you're just kind of waiting for you're just hoping that the big shotgun blast doesn't come to take you out of the game. But it's nice when it's working for you because as a guy that actively trades a whole bevy of markets, I trade currencies, I trade equity index futures, I trade stocks, I trade the ags, fixed income, and I'm looking for markets that have a lot of movement. Well, what's a nice hedge for me is that if I go short a straddle in a market that I'm looking for movement in, okay, and that market doesn't provide that movement, now I'm benefiting from the time decay or the theta decay that takes place from those decaying options right there. And so every day that market doesn't move, that time decay kicks in. And so if the market gets a little bit choppy, even in August, we all remember this robust market, since late August, September, October, November. But the market wasn't doing too much in August of 07 or of 08 here. We saw the S&P range bound for the last 2 weeks. We saw the euro and, we saw some commodity currencies clearly buckle for sure. I'm not going to say nothing. There weren't any markets moving. But the VIX really got going in after Labor Day in September when Lehman came out with that news overnight, and all of a sudden everything just got shaken from its foundation, and we just really haven't looked back since. But yeah, so the bottom line is if I can be short a straddle in a market that's not moving so much, it's a nice little hedge that even if the straddle that I'm short loses a little bit of money, I should more than make back the difference by just trading that market, because if I'm losing money on the straddle that I'm short it means that the market has a lot of range and a lot of energy in it, and that's a great thing. Okay, strangles I talked about earlier, and that's what is a strangle? Well, purchasing a call and a put at different strike prices. Whereas the straddle, I might look for the 147.5. On the spot Euro FX, on the strangles, I can look at the 140. I might buy the 145 puts and buy the 150 calls. Okay, the P&L skews a little bit different on it. I've got to travel a little bit of distance, but it is a little cheaper to initiate. But it isn't quite as sensitive with the market that's at the money in that regard. So in this case, I can be long the ICE FX Euro calls and long the DICE and also the DICE Euro FX puts. And it's similar to a straddle, but because, again, if I'm long a straddle and I'm buying those calls and buying those puts, I'm very bullish volatility. I think the market's going to range, and I'll be more than able to capture that range. If I'm short, I think we may be trapped for a little while. We may not move as much as implied volatility is factoring in. Okay, and then that's what that straddle looks like. So if I'm long a straddle here, you can see this is my max risk that I have in this position for the course of this time here, which in this case is quite some time, 103 days till expiration there, and the P&L increases accordingly. If I'm short a strangle, again, bearish, you see very much like the straddle, my max P&L is capped off in this particular instance, but and I'm spending a lot of time babysitting, and again, you can take that from there. So yeah, that's so overall that covers what a straddle does. But probably a position I put on more than straddles and strangles are collars, married puts, and fences. As they've referred to out there, they all kind of encompass the same dynamic. And what I mean by that is that the process of owning the underlying and then selling it out of the money call to pay for the put. So if I'm long a particular market, let's say I'm long the yen, all right, and I'll show you on the next slide here. It has defined risk-reward parameters, and I can trade around the underlying based on the trading range. So it's not like a pure straddle, and it does mitigate some of the volatility exposure I have because I'm selling an option along with it, and this is what it might look like. So to implement a call on the Euro FX, on the Euro, the ICE FX Euro, I'm long the ICE FX Euro, I'm long the ICE FX Euro puts, and I pay for those puts by selling the ICE Euro FX calls. So, and this is how we look at on a chart. We see here that I'm long. This is what the long exposure looks like right here. As you can see, it's very 45-degree angle, and they're going straight up, straight down. Max risk, max reward. A pretty clear cut in here. And then conversely, this is the long the put. In this case, obviously a max loss here, but that can move up accordingly. And then you also going to see here we're short the call. Okay, and so short the ICE FX Euro call in here. We have a max gain, but obviously unlimited downside risk. Now, more importantly, what do these look like when I throw them all together, and to give me the investment profile that I'm trying to achieve? And that's what you get right here. The collar position defines our loss because we have a put position protecting it right here. As you see, we're long one put right in here. We're also short one call right in here, and then we're also long the underline at the bottom leg right in there. And what that allows me to do is okay, I'm able to take on certain investment exposure, be long those respective markets, okay? But what I'm giving up, though, is I'm capping my upside. But as a single and doubles hitter, I'm not a big home run guy. I like to play range, but even when I, catch a good range, I'm still taking profits. So that's what those three legs do, and that's what they encompass and really allow me to get after and take on exposure in that regard. So again, long the underline, long the put to protect the underline, and if you remember from earlier, if I'm long the underline and long a put, I'm in a synthetic call position, okay? So now with that synthetic call position, to pay for that, I go and sell an out of the money call to help offset some of that risk, and that's a great way that you hear people talk about, Steve, oh, well, gosh, I can't be in options right now, they're so expensive, the implied volatility is so high right now, I can't do that. Well, by buying one call and selling another call out of the money, you really can at least take away a lot of that sting. I mean, to some extent. You're still going to be exposed to some of the volatility fluctuations, but you can mitigate a lot of that by selling another call of the same month or even of different months to help take that away. And that's what I do a lot.
That was a great point. In fact, I teach options I travel all throughout the world teaching options, and I get that same question, and I try to go through it the same way that you just did, talking about if you want to sell some vega or volatility, you can do that because you're buying something else, and you're just sort of capping out your gains, and that's a great way to trade. It's a great point.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.